posted up. So it looks like I've got a homework assignment myself to do tomorrow, which is get as many of these up as possible. What I'll do is I'll go up in reverse order. So I'll put tonight's up first, last Thursday, and back up till I get caught up on those. Okay. Okay, good. So go ahead and acknowledge that. And let's jump into finish up chapter 3 here. And we still had that last section dealing with impairment of assets, and pretty straightforward discussion here, in that we're going to see that if we have a situation in which an asset has fallen below its fair value, we're going to have to write it down to its lower fair value. But FASB has a pretty specific process that they want us to go through in order to determine whether it's fallen below the fair value, and then what that write down needs to be. So when you take a look, and we're going to talk about it in the context of intangible assets with finite life, but the practical matter is this also applies to fixed assets, because fixed assets also have finite life. So I don't want to repeat the same discussion twice. If we have an intangible asset like goodwill with an indefinite life, we're going to talk about that when we get into our discussion of goodwill in chapter 4. Okay, so we'll just talk about this once. We're talking about any asset, fixed or intangible, that has a finite life, meaning the life will end. So they tell us that if the carrying amount of the asset is compared with the sum of undiscounted cash flows. Okay, so we take undiscounted cash flows. If we thought this asset was going to generate $1 a year for 1 million years, we would add that up on an undiscounted basis and come up with $1 million. Okay, and we would then that we're expected to get from that asset. Okay, now right in here, if undiscounted cash flows are greater than carrying value of asset, no impairment, and no further analysis is necessary. That's step 1. Okay, you add up the cash flows on an undiscounted basis. I don't care if you have to go out 50 years, 1 million years to get those cash flows. You add them up, compare it to the carrying value, and if the undiscounted cash flows are greater than the carrying value of the asset, there's no impairment. We don't do another thing. Now, if the carrying amount of the asset exceeds the undiscounted cash flows, then the asset is impaired. An impairment loss equal to the difference between the carrying amount of the asset and the fair value of the asset is recorded. Now, when we look at that fair value is often determined by discounted cash flows. Okay, so flashcard, that's step 2, and you only go to step 2 if in step 1 what the carrying amount of the asset exceeds the undiscounted cash flows. Right now, you can go ahead and flashcard here, determine fair value, use what? Determining the impairment, I should say, use undiscounted cash flows, or determine if there's impairment. To determine the amount of impairment, use fair value, and fair value is what? Is often discounted cash flows. Okay, now we're just making some flashcards here before we get too concerned about are we fully understanding these. Let's just go over and look at a couple more things that I want you to flashcard, and then we're going to look at an example. I think you're going to see this is pretty easy. Okay, so where do we report an impairment loss, assuming we've had that? And that is reported what? That is reported in income from continuing operations. It is not part of discontinued operations, but it is only a particular asset that we are calling out for an impairment. We're not getting rid of an entire segment or anything like that we talked about in some of our earlier chapters. Okay, now you come over, and when we have found that there is impairment, okay, and it depends on whether the asset is held for use or held for disposal. Okay, if the asset is held for use, meaning we're just recognizing impairment, we're still going to keep that asset, we're still going to use it, we write the asset down, we now amortize / depreciate that new amount, and restoration is not permitted. You cannot write it back up. If you are planning on disposing of that asset, you will calculate the impairment loss, which is the difference between the fair value and the net carrying value. And again, the fair value is often the discounted cash flows. You will add the cost of the disposal. That is the amount of impairment. And then you write the asset down. You do not depreciate it any longer. You do not amortize it any longer. And restoration is permitted, but you must stop at whatever its original book value was. So you can't keep writing it up and up. You are capped at whatever its original book value was before you took the impairment loss. Okay, now let's just go ahead and let's look at this example, guys, and then we'll open it up for questions, but I think you'll see it's pretty straightforward. Okay, so we have an asset with a carrying amount of 900,000. Net future, and they should do a better job calling out that these would be undiscounted cash flows are reported at $1 million. So the what? Undiscounted cash flows are more than the carrying amount. There is no impairment loss. That means you should stop. You don't have to do anything further. You do not take any impairment. Okay. Now you go over to the next example here. And now we have what? We have the net assets carrying amount is 1.2. Undiscounted cash flows. I'm going to write in here. Undiscounted cash flows are $1 million. So now we have what? We have potential impairment, or we have impairment because what? Because the undiscounted cash flows are less than the carrying value of the asset. So what we do is we then go and take the present value of the cash flows. And again, that's often how you calculate fair value. The problem could tell you, just give you the fair value, or they could tell you these are the discounted cash flows, but now that's the number we're going to use to calculate the impairment, which is 700,000. And the assumption 1 is that the asset's held for use. Assumption 2, the asset is held for disposal. So we're going to bring a little disposal cost in here into the discussion. Okay, so asset held for use, you do what? You take the discounted cash flows. You compare that to the carrying value of the asset. We have a what? Loss of 500,000. We write it down. We now amortize that new cost. So now we'll amortize 700,000 over the remaining life of that asset, and restoration is not permitted. And again, that loss is part of a loss from continuing operations. Could be a separate line item in that section, but it is part of the income or loss from continued operations. If the asset is held for disposal, you still bring that same 700,000 versus the carrying value of the asset is 500,000, but now we have to add the disposal cost to calculating that total loss. We write the asset down. We don't amortize it or depreciate it anymore because, hey, we're not going to be keeping that asset much longer. So there's no sense in taking any future economic benefit into depreciation expense as we go along. Restoration is permitted, meaning I can write it back up to what? Back up to 1.2. I can't write it back up past 1.2. I'd be capped. Okay. Question.
I have a question. So
Yeah.
if they have a write down for an asset held for use and the restoration is not permitted, and maybe 6 months down the line they decide that they want to dispose of it, would they be allowed to write it back up, provided that the fair value of the asset goes up in the future?
Well, in this example, right, the book value of the asset would now be 700,000, right? Once I write it down,
Mm-hmm.
right? Are
Correct.
we in agreement there?
Yes.
Okay, so then if I sold it and you're telling me I sold it for cash, say, let's just use 800,000 in your example. I would debit cash 800,000, right? I would credit the book value of the asset, which of course I'd really be having to take off the original cost of the accumulated depreciation. And then I'd have a gain of 100,000, wouldn't I?
Yes.
That I would take at the time of sale. So there would be no need to write the asset back up because I'm getting rid of it at that point.
Got it. Okay, that makes sense. Thank you.
Okay. Now I know it's a little bit disconcerting from a standpoint of conservatism. Well, if you wouldn't have taken that loss, you wouldn't have the confusing gain that you're representing, say, a year later or something when you finally got rid of it. But we've accepted that financial statements are full of accounting estimates, right? And so it's simply changing estimate, and not as a profession, and we have warned the investing public that situations will differ between what we're putting in the financial statements and what actually occurs. What else can there's only so much we can do. We don't have a crystal ball here. So
I have a question about assets held for disposal.
Uh-huh.
What would be a circumstance in which you would restore the book value? Because if you're holding them to dispose of them, and you've already you've acknowledged that there's an impairment, why would you write it up? I mean, I know restoration's permitted, but like, why?
I don't know.
Okay. All right.
I reckon what they're doing there is giving us some wiggle room for this situation, where, and I'm not sure I answered Don's question now that I'm thinking about it, because he was asking about the held for use, and I'm just saying if you got rid of it later, that's when you would finally take the gain. But anyway, if it's held for disposal, I guess they're just giving us some wiggle room as we kind of, it's kind of like trying to land an airplane, right? You just don't say, okay, this is how I'm going to land the plane, and then you force it to land that way. If the wind changes as you get closer to the ground, you make some adjustments, right? And they're allowing us to do that here.
Okay.
I don't know. I've never flown a plane, so there's probably pilots somewhere laughing at me. But I'm just saying they're kind of letting us kind of get into a position where we can have a soft landing here on this thing.
All right. Maybe if you sell the entity to some strategic buyer and they think everything's worth more or something, I guess. I don't know.
Well, I'm thinking that there's some kind of, the example I used to give here, which I don't anymore, is, what happens if you have like, well, that's more of a whole product line, but let's say you've got a fleet of some kind of cars that you're saying, hey, those assets have been impaired. And then all of a sudden, what Shakira uses that in a video. And now everybody's asking for that kind of car, and so there could be some sort of unforeseen circumstances, right, that could cause it to come back up, and you're going to want to write it up.
Okay.
Yeah.
Okay. Thank you.
Yeah. Okay. All right. Let's go ahead. I'm not going to repeat, guys, what we said. If it's a fixed assets, same thing, intangible asset with a finite life. Fixed assets also have finite lives, so I see no point in us, sort of repeating what we've already said. So let's just go ahead and let's take a look at our first question tonight, and let's see which computer is going to be the one that's going to allow us to do the poll. So it's not this one. So I have to go to the other one and go ahead and put up our first multiple choice question for tonight. Okay, guys, I'm going to go ahead and call us in a little early. So take your best shot at this one. Okay, and you take a look, and most of us got it right. Okay, so the correct answer is A. And when you look at this, you're kind of going to probably laugh when you see what the answer is if you don't cry, but at least you're not making this mistake on the exam. And that they're telling me the net carrying amount is 500,000, undiscounted cash flows are 515. We stop and there is no impairment. Question like this takes you what? I gave you 2 minutes. It should have taken you 10 seconds to work this one on the exam, right?
Yeah.
Okay. Okay, good. Let's go ahead and let's take a look at question 2. Let me say one thing about question 1 before I forget. This is why the flashcards that I ask you to make are very important, guys, because if you had looked at those flashcards like I coach you to, which is, hey, you look at them just before you go into the exam. You look at them over and over again, a couple of days before your exam. You get to the exam site early, you do another round with your flashcards in the car before you go in, and then you walk into the exam like this so nothing spills out of your head, and you go and you dump everything on the exam. You yield savings, tremendous savings of time in questions like this because you just looked at these concepts in that situation. So you've got a couple of questions that it takes you 15 seconds, 20 seconds at the most to work. That saves you a balance of time that you can then apply to questions that may be a little more involved. So don't sleep on the notion of making the flashcards, having those flashcards available to you, learning the material from the flashcards, applying your knowledge of the flashcards when you're doing the homework, keeping up with the homework week to week, and then using those flashcards as you move into your final review and your last few days of prep for the exam. So don't forget to look at that how to study file and make sure you're following with the program.
Is there a poll for question 2?
No, I was in the middle of a speech there. So let me put that up. Oops, that's the last question. Okay. Okay, it looks like most of us were able to kind of maybe look at that one while I was making my little speech here. So let's just go ahead and end the poll now. And yeah, most of us got that right. I'm surprised we weren't more towards 100% on that, because you look and they tell us that the asset has to be written down. There's impairment, so they wrote it down, but the asset is used in operations. Then the value comes back up and they tell us what should we record as restoration, and the answer is what? 0. Assets held for use, restoration is not permitted. Again, my little speech about the flashcard would apply there. Okay, question about the flashcard approach? Okay, good. If there is no question, then what I'm going to do is take a 5-minute quick break right now. Okay, and so I'm going to go ahead and pause the recording here, and we're going to jump into chapter 4. Okay, now we're going to be really still focusing on the balance sheet, I guess. We're going to be focusing on investments. So we're still sort of in the asset side of the balance sheet. We'll get into liabilities when we get into chapter 5. Because as we start to buy essentially stock of other entities, we could get to a point where if we acquire enough stock, we will need to consolidate the financial statements of the entity that we have invested in into the financial statements of the parent. We're also going to talk about consolidations here. Okay, so we will start out with discussion of how to account for financial instruments using both the fair value through net income method and the equity method. That tends to be a good solid 10-point area on the exam. Okay, and then we'll start to talk about consolidations. Okay, and consolidations end up also being about a 10-point area. And so even though we've broken that up into different topics here, the reality is that is consolidations. That has long been a heavy area on the exam, and something that you can expect potentially task-based simulation. If not a task-based simulation, absolutely a good chunk, a nice boatload of multiple choice questions. Okay, and then finally we'll talk about dealing with impairment for assets with indefinite life, and the main issue there being goodwill, and that might be a fairly light area, about 3 points. Okay, but a heavy point area here obviously in chapter 4. My read as, you know, the instructor of this class. Am I the instructor? I think I am, last time I checked. Okay, the performance on those couple multiple choice questions that we had at the end of chapter 3 were not consistent with the difficulty of the issue of the area. I mean, we were getting in the 70s, that's good, but those questions were easy if you just simply followed through with what we talked about during the quick lecture there for the end of chapter 3. That implies to me that maybe I don't have your undivided attention. So I will be calling out as we go through multiple choice questions in class here, and if your camera is off, you are more likely to be called than if your camera is on. So I'm just letting you know up front so that, you know, folks don't think I'm picking on them or something if I start calling them out. Okay. All right, good. So let's just go ahead and let's take a look at the start of chapter 1 here. And it might help if I have my textbook in front of me and my little notes, which I should have put up during the break, would have been helpful. Right here now. Okay, and let's just start to take a look here at what we're talking about when we talk about financial instruments. Okay, when we talk about financial instruments, we're really talking about stock certificates. We're talking about bonds here. Okay, so really, when they get into the discussion here, we're talking about stock investments, bond investments. Again, we are the entity that has purchased this stock. We are the entity that has purchased this bond of this other company. Now, if we're the company issuing the bond, we have what? We have a bond payable liability. That's chapter 5. We're talking about we are the entity that has acquired a stock, a bond in a company, and how are we going to account for that? Now, they tell us that you have something called the fair value option. Okay. And under the fair value option, you can decide to take unrealized gains and losses and report those in earnings. And the fair value option is irrevocable and is applied to individual financial instruments, individual bonds, individual stock that you have acquired. You can account for them at fair value. And when you account for them at fair value, you will take unrealized holding gains and losses. You will report it in earnings. In other words, it goes where? It goes to the income statement. Okay. Entities have that option. You're good, Matthew?
Question?
Matthew, did you have a question? You were ahead. I think you were just writing. I thought maybe your hand was up. Go ahead, Kathy.
Yeah. So it says that they're applied to individual financial instruments. So you can take the fair value election for one of the stocks in your portfolio, but not necessarily the other. Is that
Correct?
Correct? Okay. Got it.
Yeah, that's what they mean. Yep. Okay. Now, when you take a look, they're going to talk to us about what we can and can't use fair value option for. So financial instruments not eligible for fair value option include investments in subsidiaries or VIE entities, variable interest entities, and the entity is required to consolidate. Okay. In other words, what they're saying to us there, and please flashcard that, they're saying, look, you can't use the fair value option in lieu of consolidation. If you get to the point where you have acquired so much stock of the entity that you're now required to consolidate, then we're going to take away the fair value option. But you can still use the fair value option up to the level where you get enough stock that you're going to have to consolidate. Okay. All right, good. So we can use fair value option, and we're going to talk about, you know, fair value through net income approach here in a little while when we talk about investments in stock, which we have to use for investments in stock. But where we start to go past a certain threshold of 20%, then the expectation is that the entity would use the equity method. But what we just talked about is saying you don't have to use the equity method if you have elected the fair value through net income. Then you are basically waived out of having to do the equity method for that particular stock. And so we kind of talk about it generically here, but the real thrust for something like the CPA exam is you could opt out of the equity method is basically what they're telling you there. And we'll talk about the equity method later. Okay. Okay, good. Now you come over and let's talk about investment in debt securities. Okay. And just for purposes, I mean, we can sit here all day looking at what is constituting debt securities, but just think about bonds, okay? Investments in bonds. And we basically are going to classify those bonds into one of three categories. Again, we are buying the bonds of an entity that we have decided to invest in, and the entity decides what category to put those bonds in. And depending on what category they put them in, that will dictate the way our accounting is going to go for those. Okay, so first we could put them in, and again, the company could choose wherever. They don't have to go to one or the other first, but since they've put this one first here, we'll start with trading securities. Our debt securities that are bought and held principally for the purpose of selling in the near term. Okay, so we have what? Active and frequent buying and selling of that security. And they are generally reported as current assets. Okay, although they can be treated as long-term. Okay, so you can go ahead and flashcard trading securities, and that what? Debt securities like bonds classified as trading securities are generally reported as what? As current assets. If the question tells you, hey, they have just appropriately carried it long term, you don't have to argue with that, but generally they are considered current. Okay, now I want to go over to the next category. Okay, and you'll see why in a second. I'll come back to available for sale, but let's just look at held to maturity security. And investments in debt securities are classified as held to maturity only if the corporation has the positive intent and ability to hold those securities to maturity. So they intend to, and they can hold them to security to maturity. Okay, and securities held as held to maturity securities are current or non-current based on the time to maturity, or essentially based on the time to maturity, current or non-current. So they're going to mature in the next year, current. They're going to mature in more than the next year, non-current. Okay.
Question, are call provisions ignored? Because that's a situation where it's, they may have the intent to hold it to maturity, but if it's callable bond and it's called, you've lost that ability all of a sudden.
Yeah,
Not the holder's option.
Yeah, I don't know.
Okay.
Okay. All right, let's look at available for sale debt securities. So available for sale securities now are those not meeting the definition of the other two classifications. That's why I went ahead and went to held to maturity first, because you're like, well, what's held to maturity? Okay, and those could be as either current or non-current assets, depending on the intent of the corporation. Do they plan to get rid of it in the near term, or do they plan to hold it longer term? Okay, so three categories. All we've talked about at this point is whether to put it into current or non-current. Okay, now you come over and let's talk about valuation. Okay, and we're going to talk about valuation now by category. And debt securities classified as trading and available for sale must be reported, and this is on the balance sheet at fair value. Okay, so those securities are going to be carried at fair value, and that's all I want to say there. Okay, and then if we're talking about held to maturity security, why don't you just go ahead and flash that? And that's on the balance sheet. Okay, if we are talking about held to maturity security, and I'm coming down because I just want to complete the discussion of valuation on the balance sheet, held to maturity securities are reported at amortized cost. Okay, and you can go ahead and flashcard that. So trading securities available for sale, we've seen whether they're current or non-current, and then we see on the balance sheet, we carry them at fair value. Financial held to maturity securities are carried at amortized cost. Now, just to make sure we're clear on amortized cost, it's what? it's whatever the cost is plus any what? Premium or minus any discount. And we'll talk about that more in chapter 5, but just so you understand what amortized cost is, right? Cost plus premium minus discount, that's what they mean by amortized cost. Okay, now that's the balance sheet. Let's look at the income statement effect now. Okay, so if we have trading securities and there are unrealized gains and losses, unrealized gains and losses means what? I have not sold the security, right? But the value has changed during the period because I have to mark the trading security we've seen up there to fair value. Well, if it is a trading security, unrealized holding gains and losses are included in earnings. In other words, it is reported where? Reported on the income statement. Okay, so assuming we had a loss, we would debit unrealized loss. That's reported on the income statement. And we would credit, and you could credit directly to the security or you could credit to evaluation analysis, but bottom line, we're going to decrease the value of the security on the balance sheet. Okay. Now, if it is an available for sale security, now unrealized holding gains and losses are part of my other comprehensive income. Okay, so now, since it's available for sale, we're going to do what? We're going to debit unrealized loss. That is part of my OCI, other comprehensive income, and I will credit on the balance sheet now my fair value adjustment. Okay, flashcard, how you treat those. Okay, good. So we know how we affect the balance sheet here for all of these, and for the held to maturity securities, you can just go ahead and put down they're not marked to market, and therefore there is no income statement effect. There's no income statement effect for changes in fair value. They're not marked to market. Okay. Okay, good. So, you know, I told you that I kind of called out individual flashcards, but really you could probably use this table as your flashcard because it really summarizes everything we said, how they're carried as current or non-current, fair value or amortized cost, whether or not unrealized gains and losses hit the income statement or the comprehensive income or not recognized. And then we've added a discussion of statement of cash flows. Okay, so what happens when you have cash flows being affected by these securities? Okay, you are going to report that in operating or investing for trading. For the other two categories, it's investing. And you can see here that we will put information in there regarding the trading securities, okay, in the operating section. If they're classified as non-current on the balance sheet, then the transaction will be investing. Otherwise, it is considered trading. I think I kind of said it backwards at first there, but you have the correct treatment highlighted there. You can go ahead and flashcard that as part of this flashcard. Okay, so you could look at it and say, hey, everything's in what? Investing, unless it's a trading security being carried as a current asset, then it'll be operating. Okay, now what happens if we reclass in or out of these categories? What should we do? Okay, so let's just go ahead and let's just take a look at these, and then we got a flashcard there on that table. So if we go from trading to any other category, okay, we're taking it out of trading from any other category. We've already taken the loss or gains into the income statement, into earnings, and they shall not be reversed. So you don't have to do anything. Okay, if we go to trading, Okay, the unrealized gain and loss at the date of the transfer shall be recognized in earnings immediately. So maybe we had unrealized holding gains and losses that were sitting in other comprehensive income. We're going to have to report that as part of our net income. Okay, held to maturity, transferred to available for sale, then unrealizing holding gains and losses that we hadn't taken before will now be reported in other comprehensive income. So we're going to have to catch that up at that point in time. Now, if you have an available for sale security and it is transferred to held to maturity, the unrealized holding gain or loss at the transfer date is already reported under comprehensive income, and the unrealized holding gain or loss shall be amortized over the remaining life of the security as an adjustment consistent with the amortization of a premium or discount. Now, I'm going to give you a numeric example of that because that's not exactly something that's, easy to visualize. Okay. So you can just write down a little example down here underneath this table and say company has available for sale bond investment. Okay, that is purchased for 100,000, and we'll make it sorry guys, squeeze in, it's a 10-year bond here somewhere. Sorry, it's a 10-year bond investment. It's a 10-year bond that it has as an available for sale security. It purchased it at par for 100. That's the face value at par for 100. And at the end of year 5, it has a fair market value of 110. Okay. Now, if that's the case, they should have done what? They should now have the security, and I'm just going to go ahead and investment. They purchased it for 100. Okay. It's gone up what? $10. So they increased the investment. And right now, in their accumulated other comprehensive income, they've taken a gain of $10 on that thing, haven't they? Right? Because we're supposed to put those in OCI, and then we would close our annual OCI out to our accumulated other comprehensive income. So we got $10. Now, during year 6, right, they move it to held to maturity. Okay. Well, what are they going to do at that point? Well, they would take that that $10, and there's 5 years left on that bond, right? Year 6, year 7, year 8, year 9, year 10. There's 5 years left on that bond. So they would take that, they would divide that by 5 years. And now it's like amortizing a premium, isn't it? That bond is really at more than its face. So that's like a premium. So what they would do is each year over the next, 5 years, they would go ahead and debit OCI. And I'm running out of room to write this, so I'm just going to write it down here. They would debit their other comprehensive income, $2 each year, and credit the investment for $2 over the next 5 years, so that at the end of the 5 years, the investment would have $100, which they're holding it to maturity, so it's going to mature at that point. So they would debit cash 100, credit the bond 100 to get rid of the bond. And what, each year we would close OCI to what? To accumulated OCI. So by the end of the 5 years, and I guess I can just go ahead and write $2 5 times, won't kill me, right? Because we're going to do that 5 times over the next 5 years as we close the OCI 1, 2, 3, 4, 5. Okay, sometimes I'm a little bit anal about the way I do things, but it'd be 5 years. Over the next 5 years, they would debit the accumulated OCI, and the security is gone when they sell it. Okay. Okay, good. Now go ahead and flashcard what we're supposed to do. We highlighted it up there, but you've got that flashcard, and that basically tells us what we just saw up there in the outline.
I've just got a quick question. I want to make sure I understand this. So if you're taking something out of available for sale and you're moving it to trading, you've been recognizing the gains and losses in OCI, and so you would have a balance in AOCI. When you transfer it to trading, the trading category, you would then have to back it out of OCI?
Hold on. We trade. Which, are you talking about the example I just gave you?
No, I'm talking about.
Okay. Sorry, start over again, because I was thinking about the example.
Sorry, I went too fast. I was back up to the second bullet point where it says you're transferring it to the trading category.
Right.
So let's say you have it in available for sale, so that your gains and losses have been showing up in OCI rather than net income. Do you then have to back that out of accumulated OCI and move the whole thing into net income, even though they might be for different periods?
Yes.
Okay.
At the date of transfer, gain or loss shall be recognized in earnings immediately. The whole.
And so that would be everything that you've had in accumulated OCI all along goes into earnings.
Correct. If you had gains in OCI, then you would debit your OCI and credit realized gain.
Okay, got it. I just wanted to be clear. I understood. Thanks.
Yeah. Yeah. Sorry, I had my head wrapped around what I had just said. I thought that's what you're talking about. That's why I asked you to start over. Okay, good. All right, let's take a look at income from investment in debt securities. And hey, I'm assuming there's some sort of interest income associated with that bond. I don't know of any bonds that are issued for 0 interest. I mean, treasuries are almost 0, but for the most part, you go ahead and you buy a bond because you want some interest return on that. So you would just take the interest income. Okay. Okay, good. Now, if you have impairment in a held to maturity security, okay, then you should, it is determined that the amounts will not be collected on the debt. Investment reported amortized cost. Investment should be reported at the present value of the principal and interest that is expected to be collected. And then we'll go ahead and we will recognize a credit loss for the difference. Okay, so let's just go ahead and let's take a look at this example right here, which I think is pretty good to illustrate what they're talking about there. So we take a look, and on January 1st, January 2nd, year 3, we purchased $500,000 4-year bond at par with an annual interest of 4.25, paid on December 31st each year. We classify the investment as held to maturity. At the end of year 3, we received the full interest payment of $21.50, but then determined that we would only collect $11.5 each year in interest for the remaining 3 years, along with the face value maturity of $500,000. So we need to take the present value, and we would have to use 2 present value factors, one for the principal. We'd use present value of $1, and one for the interest. We would use present value of an annuity for that for the remaining period on these bonds. So when we go ahead and we now discount the future cash flows that are going to come out of this, the future cash values of the interest using the present value of the annuity, the future cash flows of the principal using present value of $1 gives us the total present value, and the difference between the amortized cost at that point, which was the 500,000, and this present value, then we'd have to take a credit loss that's reported on the income statement, and we would go ahead and credit an allowance, essentially reducing the carrying value of that bond down to its present value. Now, that's for a held to maturity security. Okay, what happens if we're dealing with impairment on an available for sale security? Well, now we're going to have some kind of different rules here, because they're looking at that and saying, well, you could basically dump that security immediately at that point in time if you're feeling like you're not going to collect the full value on that. So they're going to ask us to treat that a little bit differently. So impairment on available securities accounted differently held maturity, because the investor has the option to sell the available security if the loss on the sale will be less than the expected credit loss. As a result, and I want your flashcard this part, as a result, the credit loss reported in net income on available for sale securities is limited to the amount by which the fair value is below amortized cost. Any additional loss is reported as an unrealized loss in other comprehensive income. So go ahead and flashcard that. But let's just go ahead and take a look at the example here, where we have 3 different scenarios. Okay, and we're going to use that same security that we had from example 1 and see how we would treat these under these 3 different scenarios. So you come over and you take a look, and let's just start with this scenario 1. Amortized cost is 5, fair value is 510. We have the expected credit loss, but we don't have to take any of that expected credit loss here, okay? Because what? Because we're sitting there and saying, well, we're carrying this thing at fair value. We have the option to sell it at this point in time and take a what? Take a gain to sell it for 510, because we're carrying it at 500, amortized cost of 500,000. And we would just go ahead and put that realized gain into the 10,000. So we don't have into OCI, I should say. So we don't have to take any credit loss in that scenario. Okay. Now in scenario 2, they tell us, well, the fair value is 480. So what happens? Well, now we're going to sit there and say, well, if it's being carried at 500,000, expected credit loss is 26.7, and so the expected credit loss that we'll report is 20,000, because we are basically able to sell it for 480. So we would really only have a loss of 20,000 if we decided to sell that, and we would show that as an expected credit loss and the allowance, but we don't have to take that full 26,297, because hey, we could sell it right now at a loss of 20,000. So they stop us at what the loss would be if we were to sell it at this point in time. Then you come into the last scenario and they're saying to us, well, look, now your loss is total, what, 50,000, right? And they say, yeah, take the credit loss for the full amount of credit loss that we calculated when we first looked at this in example 1, I guess they're calling this. And then the additional loss is part of your unrealized loss in your OCI. So you would split that 50,000 if you add those 2 numbers up, 26,927 and 23,073. That's 50,000, right? But you basically split that 50,000 loss between the entire amount of the credit loss, and then the remainder amount goes to OCI.
I have a question. Something I found confusing in this is, if we're talking about impairment of available for sale. Now, available for sale is reported at fair value, but yet for impairment purposes, we're comparing it against amortized cost.
Yes, to determine, yes, to
To
determine,
determine how much gets recognized in net income. Is that the,
to
okay.
determine how much is credit loss versus, so we're not carrying it at amortized cost, we're going to carry it at fair value. You can see that right here. So if you take a look, they go ahead and they take the, and that's actually a good question, Kathy. Notice what they do is some of that, the part associated credit loss goes to the valuation for credit loss, and the remainder amount goes to the valuation account for the adjustment to the security down to fair value because it's available for sale. So you have literally two different classifications on the balance sheet as well.
Okay. Boy, they couldn't make this any harder if they tried.
Who's they? FASB? You know.
Yeah, it's like, let's see how confusing we could possibly make this.
Yeah, you know, at the end of the day, probably what a company reports on the face of their balance sheet is, you know, available for sale securities net. And then you know, this is footnote digging stuff. You know, I wouldn't expect a real, you know, complicated, busy balance sheet trying to show every single little thing that could be possibly called out as a subtract from an asset. You know, it's kind of like sales, right? You have sales, you have discounts, you have, you know, net of cash discounts, you have returns. You know, they don't report all that detail, but somewhere in the footnotes you might understand some of the, you know, some of the subtleties. Okay, good. And then sale of securities. Okay, and let's just take a look at that. And if we are selling a trading security, the realized holding gain and loss is the difference between the adjusted cost, the original cost plus or minus any unrealized gains, and the selling price. Okay, so whatever that security is being carried at that point in time versus the cash is a realized gain. I don't even know if you need a flashcard then. Okay, good. Now, if we're talking about a sale of an available for sale security, well, that gets a little bit different. Okay, so if it's available for sale security, the realized gain or loss reported when the available for sale security is sold is the difference between the selling price and the original cost of the security. Flashcard that and put the word always next to that. Always. Okay, because from a CPA exam standpoint, you could quickly calculate what should be reported as the realized loss just by them telling you this is what they originally purchased it for, this is what they sold it for. That entire amount would go into realized. So let's just take a second here and let's say that I have an available for sale security that I purchased for $100. Okay, so I'm going to put AFS security. I'm going to tee that up and I'm going to purchase it for $100. Okay, now let's say that that security has gone up in value $10. Okay, if that's the case, then I would have debited the AFS security, right? Because I have to carry it at market. And not a good place to write the T account. And in still not a good place to write it, John. And in accumulated OCI, I guess I can't find a good place to write it because it really isn't a good place here. In accumulated OCI, sorry guys, let me write it here. It's, I guess, the lesser of evils here. In accumulated OCI, now I've got what? I've got $10 sitting there, right? Now, let's say I sell the security for $115. Okay, now let's make some use out of this journal entry here now that we got some numbers. Well, obviously, I'm going to debit cash for what? 115. I'm getting rid of the security, so I'm going to do what? I'm going to go ahead and credit the available for sale security for 110. Got to get rid of it. I have what? I have this situation where I have this $10 in accumulated OCI. So for the year, I will report what? I will report $10 and my accumulated other comprehensive income. And when I close for my other comprehensive income for the year, and when I close that out to a accumulated other comprehensive income, I'll zero that out. And now to make this journal entry balance, I need what? I need a credit of 15, and that's reported on the income statement. Okay. But an important reason I want you to flashcard this is the amount that goes into income for the period is what? The difference between what I originally paid for the security and what I sold it for. It all eventually hits the income statement. So, you know, if you see a question, you don't have to do all this to get the answer. You just simply remember this and be in good shape to answer that quickly. Okay. Okay, so now we're going to turn our attention, if there's no question on that, to, you know, let's do some real quick. I think I'm going to call an audible here. Yeah, let's do this because they kind of shift gears to equity securities after kind of having a lot of information flipping through our heads. And I don't like the timing of that versus the questions. So let's work questions 1 and 2 so we kind of test what we just learned here. And then we'll come back to some of this other stuff, because by the time we get through some of these pages that you see here, you're going to probably have forgot what we talked about for debt securities. Okay, so let's just go ahead and let's work. And I'm just going to ask you to work question 1 first, and then we'll work question 2. Then we'll go look at the equity security discussion. Then we'll come back to question 3 so that you're not trying to balance too much stuff in your head all at once here right away. I mean, eventually you got to balance the whole book on your head when you get into the exam, but I don't think we need to get to that level of understanding tonight. So I'm going to go ahead and relaunch this poll and go ahead and work question 1. Okay. We got one person still working on this one. Okay, good. Let's go ahead and let's take a look at this. And yeah, good work, guys. Looks like almost everyone got it right. Okay, guys, pay attention. I mean, there is no way on earth that B is correct. Okay, so I mean, you know, if you've picked B, you've tuned out. Don't do that. Okay. Most of us though got it right, which is what fair value. If it's a trading security, fair value with holding gains and losses included in earning. We said we even never used the phrase lower of cost or market in any of the discussion. Okay. All right. Good. Let's try to do a good job on number 2. Okay.
The poll start up for question 2.
Oh yeah, sure. Yep. Okay, looks like everyone got a chance to work this one already. Okay, so let's go ahead since it looks like everyone has participated at this point, and the poll. And good work, guys. I mean, this is a little tougher question. 75% is pretty good. Looks like a couple of us had trouble with a little bit of trouble with this one, but the answer is B. So let's go ahead and let's take a look at this together. And I'm going to stop sharing, get this out of the way for us. Okay, so what happens? They buy a security, and they buy a security for what? They must have bought it at 170,000. Okay, so what happens? They sit here, or at least they were carrying it. I don't know if they bought it for that, but they were carrying it, this available for sale security, at 170,000 at the start of year. Start of year 2, that was the aggregate cost of the thing. Then they come in and they tell us, well, it's carrying at 170. I don't know if it's the start, but by the end of year 2, they were carrying at that. And then they did an analysis and they realized that the market value is 148. Now, when you look at this thing, they had what originally took it at 170. And if they had taken at December 31st, year 1, a loss of 1,500, then they had in effect brought that security down to what? To a balance of 168,500. Okay. And then they look by the end of the year here, and what it has this value of 148 at the end of the second year, year two. So if I'm carrying the security at what? At 168,500, right? And now it's what? It's being carried at, it has a market, not being carried, but it has a market by 148. Then I need to bring that down, what, 20,500. So I will go ahead and do what? Debit OCI, 20,500. Credit the what? Available for sale security, 20,500. And when I enter that credit, it brings the security down to the 148 that I'm looking for. Okay. Okay. Let's do this. Let's take a quick break. And what we're going to do is come back and now start to talk about how we'll deal with our equity securities. I just want to put that up there so we remember to come back to section 3 here, and we'll talk about equity securities, but we'll do that after the break. Okay, so I'm showing what, about what is it, 6:25, so we'll come back at 6:35. Okay, I'm going to pause the recording. And Matthew, one of these days I'm going to owe you a soda for all the times you stood in as the monitor to remind me to turn it back on.
You almost always remember to yourself. So
Yeah, but you know, it's the I remember because I know someone's got my back, right? Otherwise I forget. So
yeah, sometimes it works that way. I got you.
For chapter 4, so that you can work on your homework for those. And so let's go ahead now and turn our attention to equity securities. Now, equity securities are pretty straightforward in that we are going to account for those at fair value through net income, basically meaning we're going to mark those securities to fair value, and we are going to take unrealized holding gains and losses straight to the income statement. So we basically treat them like, for the debt securities, we treat them as though they are in the trading category. Now, they tell us that this requirement does not apply to securities accounted for under the equity method, which we'll talk about later. So we really have what, 2 methods to account for our securities, our equity securities fair value through net income, which is just like a trading security for our debt securities, market to market. Unrealized holding gains and losses go to the income statement. And then we'll talk about the equity method, is our other method, a little bit later. Don't forget though, that an entity can elect to carry a security that would have been accounted for under the equity using fair value method if they elect to do that. And of course, once they do, then they have to stay in that method going forward. Okay, so just go ahead and flashcard the 2 methods here, but keep in the back of your mind that a company could elect out of the equity method, as we saw in the fair value option earlier. Okay, now again, when we look at the valuation, equity securities are reported at fair value through net income. Unrealized holding gains and losses are included in earnings. Okay, and so you can go ahead and I've already said that, but you can go ahead and flashcard that. Okay, now what happens when the security pays a dividend? Okay, we have an equity security, it's a dividend, and it's a non-liquidating dividend, meaning that the dividend is equal to or less than our total share of the retained earnings of the entity. Then we go ahead and we simply debit cash, we report dividend income, and that's reported on the income statement. Okay, so when you think about an equity security being held under the fair value through net income method, you really have two streams of income, any dividends and the changes in the fair value, right? And of course, if the value's gone down, that would be a loss. Okay. Now, when you have a liquidating dividend, let's take a look at this. In a liquidating dividend, it's a distribution in excess of the investor's share of the investee's retained earnings. And if that's the case, then you're going to take that excess and you're going to reduce the investment account. They're basically looking at that as saying, hey, they're kicking back a chunk of your investment at that point in time. So take that out of the investment account. Flashcard that, but let's just look at this example. It's a pretty nice little example here. And that we have this ABC Corporation owns 10% of the interest of XYZ. During the current year, XYZ paid a dividend of 10 million. XYZ retained earnings are 8 million when the dividend was declared. ABC receives a dividend of $1 million, the 10 million dividend times a 10% from XYZ, and will record dividend income of 800,000. That's the share that was up to their share of the retained earnings, 10% of the total 8 million retained earnings. The remaining 200,000 goes against the investment account. Okay. I don't know how likely it is that a company would basically pay out a dividend that wipes out their retained earnings, but if they did, we consider that a return of their investment and consider that a liquidating dividend.
Question. So then for debt securities, it matters what management's intention is with respect to their hold period. But then for equities, it doesn't matter?
That's correct.
Okay.
We either use fair value through net income or we use equity, and what triggers us into equity is our ability to control the entity.
The amount that we own, the size of our interest, right?
It is rule of thumb is the size of the interest, yes, but there are certain other considerations.
Other factors, right?
Yeah, we will look at those. It's intent and ability. So if there's something that affects going back to the debt security, it's not just intent, it's also ability.
Okay.
Yeah. Okay, good. And sometimes, this is not the auditing course, but sometimes students will say, well, how the hell do you figure out their intent? And we make them put it in the management representation letter. They got to write to us, we intend to hold this to maturity, and then they got to sign off on that. And then maybe getting to your point about the calling option, ability gets a little more tricky, but I don't think that the exam gets into the nuances of ability to hold something, because that gets a little tougher so they're going to be very specific about they intend and have the ability to hold and not have you guessing. Okay, now required disclosures, okay, and for debt securities, aggregate fair value, unrealized holding gains and losses, amortized cost basis, information about the contractual maturities. So I just ask you to flashcard those, because that's just a laundry list of disclosures. Okay. Coming down, fair value, and all public and private entities must disclose on the balance sheets or the notes of the financial statements all financial and asset liabilities grouped by measurement category, fair value through net income, amortized cost, etc. Okay, so you can flashcard that. Okay, and then I'm going to go past this example here where we start getting into a lot of detail about these different securities. We've seen how we would calculate gains and losses on those. I don't see any point in us spending, another half hour here on this more comprehensive example. We've gone to the questions. This question right here, which I think all of us got right, is basically one of the type of examples that we talked about there, and you'll get more practice with other questions, but that is a good question for you to practice with, okay, and be good at those kind of questions. So let's just take us all the way over to question 3.
The poll is not showing for me.
Huh? Anybody else having a problem?
Okay, it's up now. It's up now.
Okay, all right, sure. Thank you. Okay, let's go ahead and look at this one, and I'm going to end the poll. Okay, good. Most of us got this right, and the answer here is B. The couple of folks that chose A, I think maybe got this reversed. They're asking what should be reported on the income statement. The amount that's on the income statement is the amount that was in excess of our share of the retained earnings. That amount doesn't go to the income statement. It's what that amount is going to be a reduction of the investment account. So they asked us for the income statement. We take that amount up to our share of the retained earnings. That goes to the income statement. Any excess goes against the investment account, which is what A was saying. Okay, they asked us income statement. I think it's important to note, though, in this question, because I don't think that was brought out in the book. It's since the date of the investment, because that got a little confusing to me. And that's why I kind of said that when we looked at that example. You mean this entity wiped out its whole retained earnings in a dividend? I mean, what entity does that? That would be a little ridiculous. So it's the share of retained earnings since the date of the investment, not the entire retained earnings, the way that example made it look like they paid out their whole retained earnings in dividend. I'm like, what the hell's going on here? Why would a company do that? I think that's a flaw in that example. Okay. Okay, good. Let's go ahead and let's take a look at the equity method. Okay. And so the equity method is used to account for investment in equity securities. Okay. When we can exercise significant influence over the investee. Now, significant influence, and they tell us, and this is sort of the size test, that a company that owns 20 to 50% of the voting stock in an investee company is presumed to be able to exercise significant influence, and therefore should use the equity method. Okay. Now, that 20 to 50% rule is sort of a rule of thumb. Okay, now couple things. If a CPA exam question tells me that they're at 18%, 10%, they're using what? Fair value through net income. When a CPA exam question tells me that they own what? That they own 25%, then they're going to use what? Then they're going to use the equity method. They tell me they're 22%, whatever. Okay. Now what happens? When you get to 50% or over 50%, what do you do? Over 50%, you're going to consolidate. Okay, now that's the rule of thumb. That's sort of the size test, right? But what happens, and they say the CPA exam frequently, and I don't know how they can say frequently, but because they don't really know, but the CPA exam could ask you questions in which ownership percentage is below 20%, but the ability to exercise influence exists. If that's the case, then the equity method is still correct, and put in here vice versa. You could have a question in which what? The ownership is over the 20% threshold, but for various reasons, we won't use the equity method. So we'll use fair value through net income. Okay. For example, on flashcards, some of the examples, because I do see questions in your homework on this. The entity is in bankruptcy. Okay. The investment in the subsidiary is temporary, a lawsuit or complaint is filed, there's some sort of standstill agreement, or another small group has a majority and operates the company without regard to the investor. So I may hold 30%, but if somebody else holds what? 40%, then I'm not exerting the significant influence that other entity is. And so I would not use the equity method. So the moral of this little story here is to do what? You can flashcard this passkey too. Read the question. Read the question carefully. Just don't look at a percentage and automatically knee jerk to the equity method. Okay. Okay, good. Now you come over and let's just take a look at, they give us these journal entries without numbers. And I don't see the point, because then they give us an example that has numbers. So let's just go to the example with numbers and look at the equity method. And I can really take that poll off the page. Okay. Okay, good. So let's just look at this example. I don't think you need to look at journal entries without numbers, and then they give me a set of numbers in the journal entries, and we'll mark this up accordingly. So let's just take a look right here. So we have what? On January 1st, year one, big corporation acquired 40% of the interest in small company for $300,000. The date of the acquisition, small company's net assets had a book value of $750. Therefore, there was no difference between the purchase price and the book value of the assets. In other words, I bought 40% of the book value for $300,000. Okay. During year one, small company had net income of $90,000 and paid a dividend of $40,000. Okay. So let's just go ahead and let's prepare the journal entries, and I'm going to debit the investment, credit the cash for $30,000. I'm reporting that investment on the balance sheet, right? Okay. Then what happens? Then I get 40% of the income that the investee reported of 90,000. So 90,000 times 40% means that I'm going to debit the investment. That's showing on the what? On the balance sheet. And I'm going to credit equity and investee income. That is reported as what? On the income statement as part of my net income, right? So I take my share under the equity method of the investee's net income, and I report that as income on my income statement. Okay. Then they told us that they paid a dividend of 40. Well, I'm entitled to what? To 40% of that, or 16,000. So I'll get a debit to cash of 6,000, and I'll get a what? Credit to the investment account of 16,000. Okay. Now, what the question will generally ask you is, what is the investment income, which we know here was 36,000, or they may ask you the balance of the investment account at the end of the year. And the way to do that is by using the base pass key here that we have dealt with before. BASE is the mnemonic. Okay. And beginning balance was what? 300,000. And then we added, what was it? 36,000, guys, to the investment account for our share of the income. Then we took out what? 16,000 for our share of the dividend, and the ending balance there would be what? 320, if I'm doing my math right. Am I doing my math right, somebody?
Yes.
320. Okay. Okay, so they could ask that. Okay, so not very difficult. You just got to make sure you read the question carefully to make sure you are appropriately using the equity method. Those percentages are a good rule of thumb, but just be careful to make sure you know that they haven't put one of those exceptions in there. Okay. Okay, good. Let's take a look and see if the question were to sit there and kind of, you know, try to confuse us a little bit by having preferred stock, because we could hold the common voting stock, but we could also hold preferred stock, and preferred stock generally doesn't hold voting rights. Okay, so if we hold both the common and preferred stock, significant influence test is generally limited to the common stock. Flashcard that. Okay. The calculation of income from the subsidiary to be reported on the income statement includes whatever preferred stock dividends, and then we would include our share of the earnings. But that percentage is what? Is the earnings, I should say, first have to be reduced by any amount of preferred dividends. That yields us what? The dividend that is available to the common shareholders. And then of course we take our percentage of that. And so we would go ahead and take our share of the incomes of the net income at that point. So any dividends paid to the preferred shareholders would have to be subtracted. So rather than sit here.
So this is done sequentially?
Let me give the example.
Okay.
So I want you to see multiple choice questions 00318, which is basically on the next page. Can you put that in? 00318, next page. Because that's not something that just jumps off the page, is, you know, real understandable. But I think, Kathy, when you look at this question, we'll come back to this other one, you'll see how to do this. And let's just do this together. Okay. So we have this Moss Corporation owns 20% of Durbo Corp's preferred stock and 40% of its common stock. Durbo's stock outstanding at December 31st, year one, is as follows. And they have 100,000 preferred stock, 700,000 of common stock. Okay, so they tell us that Durbo reported a net income of 60,000 and paid dividend of 10,000 to its preferred shareholders. So I'm going to take that 60,000. That's the net income. And I subtract the 10,000 that went to the preferred shareholders. That leaves now what? 50,000 that is available to common shareholders. And since I own what? 40% of the company, then I'm going to be entitled to what? 40% of that dividend. So I'm going to get what? I'm going to get 20,000 of the, is it 20? Yeah, 20,000 of the income that's available to the common shareholders because I had to back off that dividend. Now they set me up to potentially get this question wrong by choosing B. No, because I also have to do what? I have to consider my share of the preferred dividend. So the preferred dividend was 10 and I own what? 20% of the preferred stock. So I'm going to get what? Another 2,000 that I'll be taking into my income from investment. So the answer here is what? 22,000. Okay. Okay, good. Let's go ahead and go back because there were a couple things left up there. Oh no, I guess that's not correct. So we should be able to answer question 1, but I'm gonna let you do that one. Okay, guys, let's go ahead and take a look. Looks like we
Do we have a poll? Oh, yeah, we did. Sorry. Never
Yeah.
mind. Never
Oh.
mind.
okay. Okay, good. All right, so I'm going to go ahead and end that now. And looks like we did pretty good on this one. The answer is B, but let's just sort of take a look at this. And sometimes it's helpful to go ahead. I'm not a huge fan of T accounts on the CPA exam because often on the CPA exam, they'll ask us what was the beginning balance, and T accounts aren't particularly useful for that. But since they asked me the ending balance here, in the investment account, let's just go ahead and keep track of that as we go along. So they purchased 10% of the common stock for 400,000. And here's the tip. We're at 10%, but we are the major shareholder. So they're sitting there and sort of stealthing to us that they are the major shareholder. Okay, they can have control. So they're going to use the equity method. So they would go ahead and debit the investment regardless for 400,000. We're going to use the equity method. And then they tell us that the subsidiary, this RIA, reported income of 500,000. Well, 500,000. And notice, guys, we use what? We use the percent we hold, right? Which is 10%. That gives us 50,000. We would what? Debit the investment 50,000 and credit the income. And then they say that there was a dividend of 150. Well, if we have a dividend of 150 and we're entitled to what? 10% of that, right? Then we would take 15,000. We would debit the cash, credit the investment so that the ending balance now, we could have used the base mnemonic as well, would have been 435,000. Okay. All right, not too bad, kind of fun, okay? Questions, okay? Now, what happens? In that little example that we looked at earlier, we acquired the investment for book value. That's rarely the case, okay, for two reasons. One, the assets that a company is carrying on its financial statements at historical cost will almost always have a different fair market value. So some of the value when you acquire a company is probably going to go, and it's probably going to be towards an increase in the fair value of the assets. Even then, we could pay more than the fair value of the assets. And if that's the case, then there's an implied goodwill. Okay, so what we're going to need to do is look to see if there's a difference between the purchase price and the book value of the assets, and first assign that difference to the assets that they'll have to call out in the question, the fair value of the assets that they'll call out in the question, and then any remaining difference is goodwill. Now, I want you to flashcard that, but I want you to listen to me right now. That goodwill is not reported anywhere under the equity method. We only start reporting goodwill on the consolidated financial statements. So you got to be careful, because if the question asks you what is the implied goodwill, then the answer will be whatever the implied goodwill is. If the question asks you what is the reported goodwill, the answer is what? 0, unless we are consolidating. In other words, unless we've gone over the 50% threshold. Okay, so be careful with that. That's a pain in the ass thing that the examiners love to do. I don't know why they think that's so fun. Okay, so be careful with that. Okay. Okay, good. Now you come over, and the reason I say it's a pain in the ass is I can't tell you how many times I'm going through your homework question. I'm working the homework question to see what you have in there, and I make that damn mistake. I don't read it carefully, and I'll cheat again. So it's a very, very easy mistake to make. Okay, so be careful with that one. Okay, all right, good. Now we come over, and what happens? If we have assigned excess fair value to an asset, then we're going to have what? Excess, assuming it's a depreciable asset, doesn't apply to land, okay? If it's a depreciable asset, then we're going to have what? We're going to have excess depreciation. And so what we're going to do is, in effect, lower the net income of the investee and therefore lower our share of the net income that the investee reported, because we're saying, well, the assets are worth more, so we should have taken more depreciation. More depreciation equals lower net income. Lower net income equals a lower return on that investee. So you will have to make an adjustment to the income statement, which you report as the investment, your share of the investment in the income of the investee, and you will on the balance sheet credit the investment account. Okay, now come over and let's.
Is this in the context of an acquisition? So this is basically when you buy it?
Well, we're assuming we're acquiring shares of the company, and we're assuming that the acquisition amount is less than 50%. And but enough to exert significant influence.
Okay,
So we're using the equity method. Okay. Okay, good. Once you get past that 50%, you move into consolidation mode and we throw all this out the window. And
right,
start
but
consolidating.
this isn't once you already own it, this is at the time you purchase it, right?
Well, if we, what? Say that again?
Said, we're talking about at the time we purchase it rather than this. I'm trying to figure out if it's when we buy it or if it's the subsequent reporting. I mean, I realize that you're also talking about the subsequent reporting because you're talking about the amortization, but
No. Once we have acquired the asset, the investment, and we've acquired our share of that asset, then we're on historical cost from that point forward, right?
mhm.
We don't keep revaluing the asset every time. Just like the company uses historical cost, so do we, right?
Okay,
Unless there's been impairment,
impairment, right?
then we would, be taking, but the company should take impairment as well at that point and have written it down. So I don't know. I mean, I think we're getting a little granular here, but
Okay,
we would be on historical cost. We wouldn't write it back up again. That's for sure. Right? Yeah. Now we're in the boat with them at that point. We're on there, and that becomes what it was when we acquired it, becomes our historical cost. But you'd continue to take that excess depreciation going forward over the remaining life of that asset, whatever it is. Okay. Let's just look at this example. So January 1st, big corporation acquired 40% interest in small company for $300,000. The day of the acquisition, small company equity net assets had a book value of $550 and a fair value of $600,000. Difference between the book value and the fair value relates to, okay, here we go, equipment being depreciated with the remaining useful life of 10 years. Net income is 90, dividend is 40. Okay, so if you're not having deja vu, it's the same facts. The investment is 300,000. We take 36,000 for our share of the 90,000 net income. So we debit the investment, we credit the income statement for the equity and the investee income, and then we debit the cash for our share of the dividend and credit the investment for the dividend that we've received. But now we have to figure out, well, what's the asset adjustment here? And so the fair value of the assets that we acquired were what? Were 240, and they came up with that 240 right here, 60,000. I mean, excuse me, 600,000 is what we paid times at 40%. Meanwhile, the what? Book value of the assets was 550. So there's a what? There's a adjustment up that's attributable to our share of 20,000. Now they sit there and they say, well, look, the asset had a 10-year remaining useful life. And so we're going to take that excess value that we've assigned to those assets, and that in effect does what? Reduces the income of the investee, right? And so we're going to have to adjust that by doing what? By debiting the income statement account equity in the investment and crediting the investment on the balance sheet because there's excess depreciation. In other words, the net income of the investee is less, right? Extra depreciation.
Yes.
Okay. Now, the other piece is the goodwill that is not reported anywhere. But the question could ask you, what is the implied goodwill? Okay. And the easy way to figure out the goodwill, guys, in a situation like this where you're below the 50%, for consolidation, we're going to have to do a whole nother thing. But the implied goodwill when you're below the 50% is what did you pay? What did you get? For questions where they ask the implied goodwill, okay, when they ask for the implied fair goodwill, not what's going to get reported, it's what did you pay versus what was the fair market value of what you got. They paid 3, they got what? Fair market value of 600,000. That's since we only got 40% of that though, that's 240. So the implied goodwill here is what? 60,000. I'm just going to write that 60,000 again. That's the implied goodwill. But be careful. That goodwill is not reported anywhere because we're not consolidating. And the goodwill only gets reported on a consolidated financial statement. Question? Okay, good. Now, if there is impairment, okay, and an impairment occurs on the equity method is recognized in the following 2 steps. The fair value of the investment falls below the carrying value of the investment, and the entity believes that it is other than temporary. If both conditions are met, the entity reports the impairment loss on the income statement, and the carrying value of the investment is reduced to the lower fair value on the balance sheet. Okay, and we are not allowed to reverse that. And again, they're calling out US GAAP. I don't know why. I guess they couldn't do a search and destroy on US GAAP because there may have been some places where they wanted to say US GAAP, where it would have been useful information. IFRS is not tested on the exam, so we don't need to worry about, IFRS or anything other than US GAAP here. Okay. All right, good. I don't think we need to look at that example. Just go ahead and flashcard those rules, and then let's look at these questions. Okay, good. Let's go ahead and let's take a look at this one. Looks like most of us have had a chance to try it. And okay, a little under the 75% that I would be looking for here, but let's just take a look at this one together. And I'm looking, and got a few folks wanted to pick C. Okay, I'm not sure why, other than maybe you were confused by the question, and sometimes folks default to C. The answer is B. Okay, but let's just go ahead and let's take a look at this one and stop sharing then. And we have Park Companies, the equity method to account for January 1st, year one purchase of Turn Inc.'s common stock. On January 1st, year one, the fair value of Turn's FIFO inventory had in land exceeded the carrying amount. How did the excess of these fair values affect our reported equity in the earnings? In other words, what we're going to report on the income statement is our share of the investee's income. Do you depreciate land?
No,
No, not depreciate land, so there is going to be no effect. There's no depreciation on land, no effect on income. So you immediately get rid of what? A and C. Now you just have to figure out the impact of the inventory, right? Okay. And so what happens? Well, they had the beginning inventory. And they're saying that the beginning inventory should have been more, right? At fair value. Okay. And then they had purchases. Okay. That gave them what? Goods available for sale, which is up. And then you did what? You subtracted your ending inventory. Okay. And that gave you what? Cost of goods sold. And since it's FIFO, you have considered those ending inventory items that would have been written up are in cost of goods sold now, right? And so the cost of goods sold is up, and if cost of goods sold is up, net income is what? Down. So we would have had a decrease in the share of our investee's income because the investee would have had a lower net income if we considered a higher cost to the beginning inventory, right? Okay. Okay, good. Let's look at this next one. Slow down, guys. I'm just looking at the choices. You're driving drunk. Look carefully at this. Okay, let's go ahead and let's take a look at this one. I think we started to come around a little bit. It looks like a couple of us still might be struggling a little bit, but let's just take a look, okay? And looks like most of us, did I share the results now? Most of us got it right. Okay, the answer is B. Okay, but let me get that off the screen, stop sharing and move that out of the way. Okay, let's look at this one. Now, when they sit there and they say the goodwill attributed to this, then I'm going to report a number. I'm going to have to pick a number. I know 0 is probably not the answer. 0 would be the answer if they said, what is the goodwill reported? Because there is no goodwill reported here because we're not going to consolidate since we're what? Below 50%. Okay. So what happens? Once you realize that about this question, it's a piece of cake because it becomes, what did you pay? What did you get fair value? Okay. So what did I pay?
200,000.
I paid 200,000. Good. What did I get? I got what? Value of 600,000, didn't I? But I only got 30% of that value. I didn't buy all the stock. I didn't buy the entire company. So 600,000 times 0.3 is 180,000.
Yep.
So I paid more than what I got. They call that goodwill. Apparently, there's something so wonderful about this company that I'm getting, or this share of this company that I'm getting, that I'm willing to pay more than the fair value of the assets. That's called goodwill.
So then it's going to specifically say reported if they're wanting to know about the reporting. Attribute isn't sort of code for reporting. No, that's
No,
attribute is an implied goodwill question.
correct. Did I say
Okay.
implied before? Yeah. Attribute. Yeah. Reporting, it would be 0.
But if you're not going to do anything with it, what's the point of calculating it?
I don't know.
I made that exact same mistake, Kathy. I had picked B on my paper, then I chose A when I looked at the tribute.
Yeah,
I
to me, it was a question reading problem, and yeah. Thanks for
Yeah.
making me feel less bad, Matthew.
Yeah. No, it's reporting. If it says reported, the answer is 0. Attribute, apply, implied goodwill, that's fine. You're asking me what's the point of reporting it or recording or calculating it? I don't know. Companies might have a lot of reasons why they want to calculate that. I have no idea. Okay. All right, good. Let's go ahead and let's take a look at question 5. Poll. Okay, let's go ahead and take a look at this one. Okay, slim majority of us got it right. I guess this is a hard problem. I'm not sure what the problem is, but let's just go ahead and let's take a look at this one together. Okay, so we are being asked, what should we report on the income statement? So we're going to have what? Investment income that they're asking us about in this question, but I'm going to go ahead because they could ask me about the investment account. So I'm going to keep track of the investment account too. Okay, so Puff acquired 40% of Straw Inc.'s voting stock on January 2nd, year one, for $400,000. Okay, so I know I'm going to debit investment, credit cash for $400,000. The carrying amount of the net assets at the date purchased totaled $900,000. Fair value equaled carrying amounts for all items except equipment for which we have fair value that exceeds carrying value by $100,000. This equipment has a 5-year life. During year one, Star reported net income of $150,000. Okay, well, if that's the case, and I'm using the equity method because there's nothing in here to make me think I shouldn't use it, 150, I have the 40%, I'm well over the 20% threshold. 150,000 times 0.4 means I'm going to debit the investment for what, 60, and credit the investment income for 60. Okay, so just looking at this question, and we had, I think, other ones chosen, I can't see any reason on earth that we would choose anything but B or D, but D is not going to be the correct answer because now I have to deal with the excess depreciation on this equipment. So since the equipment was acquired for what? Had a carrying amount, a fair value that was 100,000 more than the carrying amount, I have to take excess depreciation on that. So I'm going to take the 100,000, divide it by what? Divide it by the 5 years here. So that means there's excess depreciation of 20,000 per year. But then that's the entire amount. I'm only what? Taking 40% of that excess depreciation. So maybe that's why some folks maybe took I see how 40,000 might have confused you. So that means that I'm supposed to do what? Take 8,000 out of the income and of course out of the investment account. And so the answer is B, 52,000. Question? Okay, good. Now, not in this question, but let me just ask you, is there any implied, attributed goodwill here? If I paid what? I paid 400,000 and I got what? Something that was worth, and they're telling me it's worth $1 million, isn't it? The 900,000 plus the additional 100,000 for the fair values. So that means that it's what, $1 million, and I got what? I got 40% of that. So I essentially did what? There's no goodwill. I paid fair value for this thing, didn't I?
Yeah.
Okay. Okay, I'm just pointing that out. I don't know what use that is, but it seemed like a interesting point a minute ago. I don't know. Okay, all right, good. Come over and let's take a look at what happens if I start to acquire more and more shares of this company. So what happens? I first acquire 10% of the shares. Then I get what? Then I get 30% of the shares. So I've gone from not equity method to what? Equity method. How should I deal with that? So when significant influence is acquired, it is not necessary to record a change from fair value method to equity method. It is necessary to do that by doing the following. Add the cost of acquiring the additional interest in the investee to the carrying value of the previously held investment, and adopt the equity method at the date and use it going forward. Retroactive adjustments are not required. And tonight, before you go to sleep, you can say a little prayer of thank you for that, because the way they used to make me go back and make retroactive adjustments was ridiculous. And finally, I think FASB had mercy on all of us and just went ahead and said, just go forward. Okay. Okay, good. Let's take a look at basic consolidation concepts. Yeah, we got time. Okay. And what happens when we go over the 50% threshold? Then we will go ahead and we will consolidate. Okay. Now, under US GAAP, again, that's all they test on the exam, entities must be consolidated when you go over the 50%, unless you have these, and guys, you can flashcard these, but you know, the question's going to make it pretty clear to you what they're talking about when they say, well, there was a reorganization or something, then don't consolidate. Okay, but 50% is the rule of thumb. You will go ahead and consolidate. Okay. Now, when we can acquire these shares, okay, and we've acquired the 50, the more, I keep saying 50%, the more than 50%, 50.000001%. Once you go past 50%, we'll just say 51%, then we are considered controlling interest. Non-controlling interest is the rest that is not attributable to the entity that has the controlling interest. So if we acquire 70% of the stock, we obviously are the controlling interest. The 30% is considered a non-controlling interest. Okay. Now, when you do this consolidation, okay, yeah, I think I'm going to do this example right now before we go. I think there's a question down there. Oh no, there's not. Good, they took that stupid question out. Good. Okay, never mind. Good. I'm glad they didn't put that question there, because it's not time for that question. They probably realized that. Okay, now, guys, I'm going to punt to the video here. I'm going to ask you to review the Becker video here. Okay, because at the end of this discussion, it becomes nothing more than a long listing of definitions and whatnot that no examples, and it just starts to become more and more stuff that I'm talking about rather than showing you the way these things work. So I'm going to ask you, I think it's going to take you about 10 minutes to look at that video portion on your own. Okay, what I want to do is spend this little bit of time here, this time that we have left, and there's that question now, and I'll put that question up after I go through this example. Okay, but first I want to just let me do the example first. Okay, and I'm going to put an example right here, guys, and I apologize that it's going to be a little bit sloppy, and I'm going to give you time to kind of copy this down as I go along. Okay, but let's say I have a company. Let's say I have a restaurant, and so I have this company. We'll call it company P, restaurant P, and let's say I have cash of $1 million. I have liabilities of 0. And I have, say, common stock that I've issued. Total is 500,000. And, oh, sorry, forgot, guys. I have equipment of 500,000. And I have, obviously, if my liabilities are 0, I need some more equity. So I have a pick of $1 million just to make the balance sheet balance. With me so far? Okay. So I go somewhere and I'm kind of, a restaurant guy, and I go to restaurant. How do you spell restaurant, guys? No, I can't spell. I go to restaurant S. And I go to that restaurant and I look around and I see a bunch of old funky equipment. Okay. And their equipment has a fair value of 50,000. And I call the guy over and I say, hey, I'll give you 50,000 for this place. And of course, he's a corporation, so he has common stock of 50,000. And I look around at his equipment and I say, I'll give you 50,000 for all this junk. And he says, get the hell out of here. I'm not selling you this place for, and then you leave. I'll pay 50,000 and I'm going to take over your restaurant. He says, get the hell out of here. I'm not giving you 50,000. This place is worth $1 million because of all the goodwill I have and all the customers I have and stuff. So we sit there and we talk and we finally agree, okay, I'm going to go ahead and I'm going to just pay you $1 million for this. Okay. So when I do that, I'm company P here. I'm going to now debit investment and I buy all the stock. I'm going to debit investment for $1 million and I'm going to credit my cash for $1 million. So now my cash is how much, guys?
0.
0, good. And I have an investment of $1 million. And my balance sheet still balances, doesn't it? Okay. Now what's happened? I've bought 100% of the stock of this company. And they tell me that when I own more than 50%, I have to consolidate them. So I'm going to do the acquisition date consolidation then. Okay. So I'm going to go ahead and I'm going to put a couple of lines up here. Okay. And this is basically a worksheet. Not a worse sheet, a worksheet. Okay. And I'm going to have debit and I'm going to have credit. And then I'm going to have what? Consolidated statements over here because the damn FASB told me I have to consolidate when I buy more than 50% of the stock. Okay. So what am I going to do? Well, I'm going to look, and now I'm going to start to run out of little room here. I need a little more room down here. And I'm going to make up some consolidating entries. And I'm going to enter these consolidating entries on the worksheet. Okay. So what do I have to do? Well, since I'm going to consolidate, there is no more investment in a separate company. We are now one company, aren't we? Trying to consolidate one company. I don't have a consolidation in another company. It's one company. So I'm going to go ahead and I'm going to credit the investment for $1 million. And these entries, these consolidating entries are going to just be made on the worksheet. I'm making these on the worksheet. So I'm going to go ahead and I'm going to credit the investment for $1 million. The shares that I bought, right? What did I do? I took those shares and I called them investment on my balance sheet, didn't I? And I kicked out the old shareholders. They're gone. That guy's now gone enjoying $1 million on a beach somewhere, right? Okay, so that guy's gone. And so there is really no more separate stockholders' equity of that separate company. I gave up cash, my cash, for those shares, which I called investment on my balance sheet, didn't I? So for the consolidation purposes, I'm going to have to debit the common stock of the sub. So I debit common stock of the sub 50,000, right? And now I look and I'm like, okay, I bought book value of 50 for $1 million. So that difference, and I've also said that that book value is also the fair value. So now I'm gonna have to squeeze this down a little bit. Sorry, guys. Credit the investment for $1 million. And now I report what? Goodwill of 950. Okay. So now I'm going to have to do what? I'm going to squeeze goodwill in here. And I'm going to debit goodwill 950. I'm going to do what? I'm going to credit the investment for $1 million, and I'm going to debit the common stock of the subsidiary for 50. So now when I prepare the consolidated statements, I have cash of 0. I have equipment, and you just add across. I have equipment of what?
550,000.
Good. 550,000. Good. I have investment of what? 0. I'm kind of reluctant to even write it because they wouldn't say investment 0. The investment is 0 now, isn't it? Okay. And I have what? Goodwill of 950,000. I'm just bringing that across. Not very well. Hard part is keeping this whole thing lined up. So I have goodwill of what? 950,000. My liabilities are still 0. And I have common stock of what? 500,000 and a pick of $1 million. Okay, so a couple of takeaways from this very, very simplified example. A couple of takeaways from this very, very simplified example, which is what? The common stock of the subsidiary, the stockholders' equity of the subsidiary is gone. I don't bring over their, assuming it's 100% acquisition, I don't bring over any part of their stockholders' equity. Nothing comes over from their stockholders' equity because they're gone. I had an investment. I call it investment. And I got rid of the $1 million investment, didn't I? So that's gone. I brought on their equipment. I brought on the what? The difference between the fair value and what I paid. I now am reporting goodwill. And the only thing that is left is what? Is the equity of the parent in the equity section. So in effect, when you look at this consolidation, and this is a little bit, I always thought this was a little bit of a scary picture because I have this hand reaching out from the grave and pulling in, this is a good time of year for that, and pulling in the subsidiary. But at the end of the day, you have what? You don't have parent and subsidiary, you have what? You have the parent company's financial statements of which they have pulled in the information from the consolidated company, haven't they? Isn't that what basically happened here? So what's left is what? Is the financial statement of the parent. Now, the reason this quick little simplified example is important is that on the CPA exam, they love this question. They tell you the stockholders' equity of the subsidiary. They tell you the stockholders' equity of the parent. And then they say, what will be the stockholders' equity of the consolidated? And the answer is what?
The parent.
The parent stockholders' equity. The subsidiary is gone. It is no longer considered for consolidated. Legally, they may still be a separate company, but from an economic standpoint, there is no separate company. It's just one big company now.
Question, if in your example, say 90% of the company had been purchased, and so still,
We would still get rid of all the equity, but I don't want to deal with non-controlling interest right now. We're going to
Okay.
have a whole discussion on that. Your
All
point
right.
is well taken, but I just want to get this out there as just an initial big picture, guys. This is where we're going. Okay, but we will get to that.
okay,
You still eliminate, let me just answer your question because now I even understand what you're trying to say. You still eliminate all of the subsidiaries' common stock and any other retained earnings. You get rid of all of that. I mean, any other stockholders' equity, I should say. But you will then bring in a separate equity account in the consolidation called non-controlling interest.
okay,
We'll talk about that later.
all right. Thank you.
Okay, yeah. Okay, all right, good. Now, with that, let's take a quick look at question 1 here. No, not yet. Let's do this, and then we'll finish with that question. Okay, so what happens? Oh, no. Now, let's just look at this one question, then we'll pick up. Yeah, we'll pick up with module 4 next time. Okay, so let's just go ahead and take a look at this question 1 here. Okay, guys, looks like most of them have had a chance on this one, so I'm going to go ahead and end the poll, and let's take a look at the results here. And most of us got it right. Basically, after the consolidation in which which star is the parent, we essentially consider what this consolidated statement, the consolidated statements of the parent who is pulled in the subsidiary, right? Okay. I mean, the parent could have more than one subsidiary. You know, they're not going to sit there and say, these are the financial statements of son and daughter and nephew and niece. They could have several. So at the end, we sit there saying it's the consolidated financial statements of the parent. Okay. Choice D sounds like a lot of pain. I mean, this would be very difficult to turn them into one general ledger system. You know, it would be pretty tough to do that. So that's from a practicality standpoint, that's not a right answer. And then I think a few folks pick C. After consolidation, the accounts of both star and son should be changed to reflect the consolidation totals for future ease in reporting. No. That's not what we did. We had a different set of information that got reported over here. We brought in goodwill and stuff, right? We didn't combine all their accounts. Okay. Question? Okay, guys, homework assignment is to look at that variable interest discussion that we went by, and we're going to hit the ground running on the chapter 4 acquisition method next time. Okay. All right, guys, have a good study weekend, and I will see you next week.
Thank you, Professor.
Thank you,
Bye,
Professor.
guys.
Thank you.
Bye.
Hey, Professor.
1 sec. Let me stop the recording, please. Yeah.
Okay.
Just want to stop.